And I think morals, man, bringing people that care, that see the vision, that want to be a part of the vision and want to push the vision forward, that align core values. You have to have pillars in your business that are defined. And as long as they align with those core pillars, then you know that no matter what, you guys are along, you have the right mindset and the right people are on the team. And maybe there is room for improvement. You could push them. And assuming they want to be a part of it and they want to improve, they're coachable, then yeah, that's what it's about.
All right, guys, welcome to another episode of The Report. Today, I got someone who's doing big things in the commercial real estate space and in a niche that I have personally never heard of until I met this man. He's very humble. He is Joseph Silva. Joseph, welcome to the show, my man. I appreciate you coming on.
I appreciate you having me, man. I really do. This is pretty cool. First official podcast guesting. To be honest,
this is the first time ever for you being on pod.
I had my own pod, and that's starting. I'm ramping up
but
a little
guesting
bit.
on a pod.
Guesting on a pod, location, studio like this. This is second to none, man.
I love it, man. I love it.
Appreciate you having me.
Of course, man. And I would never know. You're very cool and just like very calm and chill. You got a certain aura value, man, that a lot of people don't have. But anyways, and by the way, crazy story about you, coming in with the federal monument here in San Diego. We'll have to circle back on that story later in the show. But first things first, man, you're doing big things in the 1031 exchange space. This is a business model that I've never heard of before. Explain this business model and how did it come to fruition?
Well, let's just take it back. So I got my company, CCG Real Estate Advisors. I'm co-founder with my business colleague, Armand Bonitaba. We have a team of 4. And basically what we are doing is helping mom and pop investors understand how their money is working for them in real estate. More often than not, individuals have gone about their life acquiring real estate, older folks specifically, just buying one property, leveraging that property in the future to buy the next property. And they continue to do so because it's easier to do so back in the day when, even though interest rates could have been higher, the cost of real estate was really low. They just continued to buy more real estate. And, at a certain point in their life, they have 10, 15 single family assets, maybe small multifamily assets. Now they're managing on their own. They've owned for 20, 30 plus years. And they don't really understand how that money is working for them that's in those vehicles. There's a ton of appreciation that they're seeing, and they just don't understand what their return on equity is. And what we do is we help them understand, basically as simple as it could be, like, this is how your money's working for you, and this is what your money would be doing for you if it was in another vehicle.
That's really good. And so now you're educating them essentially. And I agree that a lot of these mom and pop types of real estate owners, they have a lot of equity in their homes. A lot of their homes are probably a little bit tired, and there's a little bit of value and upside there for a new buyer to come in. But also, one of the big plays of real estate investing is the depreciation. And so when you own real estate for a long time, a lot of the depreciation kind of runs out. And so it's probably a way to reset your return on equity, but also a way to reset your depreciation.
Absolutely. That's a huge thing that a lot of my clients aren't aware of, or they don't think of. They're aware of it. They're real estate investors. They own 10, 15 single family assets. They've owned them for several years. But it's not something they think about. There's actually a client I'm working with right now. I think this would be a great example. So he's owned this asset for 38 years up in Murrieta, California, and he owns it outright. Tenants he's had there for 10 plus years, under value market, rents. And he basically was like, yeah, I'm doing quite well. I got no real reason to sell whenever we approached him. It was a cold call. He's like, no, but the question was, when was the last time you had a second opinion? I sat down with him, uncovered what his return on equity was, and honestly, he was doing quite well. To be honest, his tax basis being as low as it was a fully depreciated asset. But his return on equity is like 5%, 5.5%. And more often than not, like whenever I'm reaching out to individuals that own assets like this, they're probably doing 2 to 3% max, like more often than not, which
in a lot of years is below the inflation rate.
It is. But their justification for it is tax basis is so low. I would have to find something else. It's always a hassle finding something. I know what I have. I know the ins and outs of this property. I've owned it forever. It's just more of a hassle to do something, even if it does make financial sense, than it would be for me to keep what I have. And basically what we helped him see is, although his return on equity is, 5%, there's so many other benefits to investing in real estate. Like you just mentioned, the depreciation schedule for which he had nothing left in. He is no longer depreciating this asset. Debt pay down, tax benefits, interest rate for which although interest rates are higher, you can utilize the interest rate that you're paying more often than not being paid for by your tenants as a tax benefit. There's a lot that goes into it, but what we just helped him understand is that you can be doing better. Let's define what better would look like. And on the off chance we come across something out there that fits your buy box, I understand you don't want to take the risk of actually selling your asset before you identify your up leg.
Mm-hmm.
In the off chance we find that up leg, we'll know what that is, and then we'll bring it to you and we'll talk about it and uncover if it's actually something that would fit your buy box. And that's what happened. And actually, we're under contract currently for a 5-plex that's fully renovated, hands-off investment for him for the most part, helping him sell his property. We're doing so. We're in escrow currently, and we're going to help him 1031 exchange his money over into this 5-plex, fully renovated, new construction property. And the intent of the move was more than just the financial standpoint of it, because more often than not, this is like they're trying to create legacy assets. A lot of our clients are thinking about like, what am I going to be passing down to my kids? What are my kids going to want to hold? Are they going to want to hold something that's a 40-year-old asset, or would they want to hold something that's pretty much turnkey, stabilized asset, something that doesn't have any deferred maintenance, brand new build? And that was a large part of why we're able to make the move that we did, or help him buy this property. It was a fully stabilized asset, and 3 of the units were brand new build. So he was like, I don't have to worry about what's going to happen whenever this gets passed down to my kids. And more importantly, I don't have to worry about it for the next 5, 10, 15 years as I'm going about my life trying to enjoy retirement.
Sure. I love the model because I feel like there's a lot of people in the real estate space that are representing buyers and sellers, but they don't really know a whole lot of in terms of like the commercial real estate. But you're offering a service, you're educating folks, you're helping them. You're essentially like a financial advisor, but in the commercial real estate space, and you're allowing them the opportunity. You're just showing them, hey, these are the tools that you have currently. These are the assets that you currently own, and this is how we can increase your return on investment. Simply by just making a couple pivots and a couple changes. And then you also do the servicing, you represent them, you make it pretty much hands off. And so I think it's pretty cool and unique business model. And, cause I think of other commercial real estate, agents out there and brokers, they're knocking doors, they're doing door knocking, they're picking up the phone, dialing. I'm sure you're still picking up the phone and dialing, but, they're not offering this service. And I thought this was pretty unique. And so let's just say that a buyer, I guess I'm curious for you, like, a lot of these owners that are like, okay, I'm interested to see what this would look like. What's the next step from there? Are you asking them, hey, what would be like an ideal property or asset for you to own moving forward? Like, what does that look like?
All right, so maybe I kind of show you a little bit of the inside of what's going on in my team. My team is primarily, we're new to this area.
Sure.
First off, we started up in San Luis Obispo, smaller market. We wanted to expand into a market because what we're doing is working with investors. There's a larger pool of investors clearly down here than there is in San Luis Obispo. So more opportunities, less likelihood of actually capping out. There's quite a bit to get done down here. And although it's a saturated market with real estate investors or real estate advisors, or I guess more so realtors, there's plenty of room to stand out. So I guess what I'm trying to say is what we do is we're in this business not for transactions, but really for relationships. We start out by seeking to understand it. There's like a 3-step process. Whenever we get in contact with an investor, it's an exploratory meeting. We book an exploratory meeting with myself and Armand, the other head of my team. We get to understand who our clients are, how they got to where they are in their investing career, and where they want to be. And then the more clear we can understand where they are currently and how their assets are performing, and more clearly we can define what the next step could be, where they want to go, what the goals are in real estate with their real estate portfolio, because a large part of it's usually retirement planning or legacy planning. We basically are able to, once we define those 2 points, we're able to help bridge that gap. So the first meeting is usually exploratory. Who are you? What do you have? What are you hoping that we can do to help you out? And then once we have an understanding of who they are, then let's define where you're at. Let's look at your assets. Let's define how you're performing. Let's look at what your return on equity is. Let's see if there's anything that we're missing here. And then let's see if we have any opportunities currently off market, because we have a list of opportunities of individuals that are like, yeah, if this number comes around, I'll probably consider selling. We have a list of those. And if that's not there, then we'll define what it possibly is going to be that you're wanting to move your money into. And it's not really a matter of if we ever find it, it's more so a matter of when, because we're always reaching out to new people and turn over stones, finding new opportunities.
Yeah. And those those sellers that are like, hey, I'm not interested, but if you got a buyer at this number, I would be a seller. How come you're not just taking those to market?
We try to.
You try to, and then if they say no,
Well, we don't try to. It's basically we help them understand how they're doing, and if it makes sense, if they are in fact motivated. If there's a an actual pain point that we can help solve and alleviate and move their money, like we'll do our best to ensure, like help them sell the property for the most amount of money. You and I both know that a property that's sold off market versus on market, it's never going to sell as much. If there's more competition on the table, a property 10 out of 10 times will sell for more. So introducing competition in the sell process will guarantee our sellers like to net the most amount of money, and making sure properties go to market is something we always push for our sellers to do. It's like, it makes total sense. Now there are the off chance that, I have somebody that has to buy something, they're in a 1031 exchange and they're willing to pay what that individual is looking for or more. We can piece things together off market, but more often than not, it's let's prep your property for market. Get that thing out there and make sure that you're taking out as much equity as you possibly can so we can move as much equity into the next property as possible. The better they do, the better we do at the end of the day.
totally.
So we always advise what's going to make the most sense for them. Obviously, we do better because of it.
I think one of the misconceptions in real estate investing is a lot of people think, because it's an off-market opportunity, that it's a better deal. But it's a lot of off-market opportunities are because the seller just is not interested in selling unless it's a really attractive number for them.
Yeah, sometimes the idea of taking their property to market is too daunting to them. They got bigger priorities on their plate. They don't want to deal with it. You bring the right buyer at the right number, put the deal together, and sometimes it's reasonable, sometimes it's not. It just depends on the client and the situation.
Or sometimes a group might not want the asset to be marketed online because maybe they don't want other people in their network to find out it's being shopped.
That's real.
Or
Yeah.
maybe they have staff at the property. Maybe it's a hotel or a apartment building and there's on-site staff, and they don't want to spook the staff because maybe they're not 100% committing to selling. They just want to see what kind of numbers they might be able to get. And so they don't want to spook the staff either. That's part of it.
Absolutely.
Yeah.
Boutique hotels, that's a big part of it. Event spaces, wedding venues.
Mm.
They don't want to spook their clients that have, reservations 6 months to a year in advance. Their property's being sold, that they have a wedding venue. Even if like we're looking to sell to another wedding venue owner that's willing to keep the individuals that have booked plans, for that property established and agreements made. They don't want the risk of those individuals feeling like there's uncertainty and them losing that business. So there's scenarios where, there's other reasons why they want to take the property to market other than.
Yeah. So when you're sizing up the return on equity, and just to be clear for the listeners listening, what exactly is return on equity? How do you define that?
Net operating income divided by the equity that you have built up in that property is basically what it comes down to. What is your gross rents? Let's look at all the expenses that are going into that. What is your net operating income? Let's define it. And then let's evaluate your property and find out what we assume the property would be worth if you took it to market today based on comps. And that net operating income divided by their equity will be their return on equity.
Yeah. And most of these folks you're speaking to, they don't have any debt on the property. These are paid for free and clear.
Some do.
Some do.
It's
Yeah.
client specific.
Sure.
So there's another scenario. There's another type of client. So the individuals that we've been talking to about thus far in this conversation is like the retiree kind of approaching retirement kind of clients, legacy, retirement planning kind of clients. So they're more passive is how I would define them. Then we have the more active clients. And more often than not, we're actually able to marry the two. So we have the passive clients that are tired. They don't want to do the work on their property. They don't want to, kick out the tenants that they have relationships with and bring the market rents or renovate the units and bring the units up to market rents. Then we have the active clients that are the ones that are looking that early on in their investing career, more often than not, looking to take on a little bit more risk, looking for the deferred maintenance assets, looking for the uglier assets, the ones that need work because they're willing to do that work. They're willing to be aggressive and get the tenants out of the property to bring the property up to, market rents, add ADUs, all the above. And so we're coming across individuals that have the assets that are like, I'm not trying to do the work, but I would like to have an asset that is stabilized. And then I have the guys that have stabilized assets because they're buying properties that are deferred, that are ugly, that need work. They're stabilizing and then they're offloading them. So I have individuals that are willing to purchase the properties from the guys that are not looking at doing the work. And then more often than not, these individuals that are actively pursuing properties and renovating them and adding ADUs and stabilizing assets have assets in their portfolio that I can introduce to the individuals that are looking for stabilized assets.
Which pool is larger?
I think there's more individuals on the passive side that have acquired assets that aren't being serviced than there are active. I mean, I don't know. It's a hard
Because
one to
I think
answer
of
because
the active investor, and we're active investors, and so we need to buy at a discount, and then we need to have a clear path to add value. And so for us, that's kind of our avatar. And so I think about other active investors. If these guys are not actively trying to sell and they're holding, yeah, I don't know. I just think active investors that are trying to exit these deals, they're going to be more aggressive with the sale process, and these aren't going to be deals that are just sitting there for years and years and years. I don't know. If I'm actively trying to sell a deal, I'm going to move it quick. I'm going to price it to where it's attractive. You know what I mean? If I have a really good opportunity that I want to pick up, like, for example, I'm selling my Cincinnati 11 unit right now. And so I have a good opportunity to move that into another investment here that's going to make me more money and has more upside. And I've kind of maximized all the upside with that Cincinnati property. And so I priced that to a decent pricing guidance to where it would sell really quick, because to me, it's more important to move this into, an opportunity that can make me more money. There's an opportunity cost if I can't sell it quickly to where I lose out on that opportunity. You see what I'm saying?
totally, there's always more money to be made on the buy side than there is on the sell side.
Mm.
And sometimes you got to sacrifice a little money on the sell side so you can make a deal happen on the buy side.
Yeah.
If you make money on the buy side, it's easy.
They say you make your money when you buy, which I think you establish your baseline profit when you buy below market. But I also think that you make a lot of money when you optimize and operate correctly.
Oh, absolutely.
Yeah.
Absolutely. It's important to have a business model defined. Have a couple of different exit strategies before you even consider purchasing property.
100%. So real quick, for listeners listening right now, like I think the main reason why return on equity is very important is, let's just say, for example, you buy a $1 million property today, and let's just say, well, this would be a very high cash flow. Let's say it's a property that you buy for $2 million today. And let's just say that you put $1 million down. So you have $1 million of equity. And let's just say the net cash flow is $100K. So you're making a 10% return on equity right now. And let's just say that, in 15 years, that $2 million property is now worth $6 million. And let's just say your net cash flow is still $100K. Well, $100K divided by, and let's just say in the 15 years, you pay down the loan and you got $5.5 million of equity. That $100,000 of cash flow divided by the $5.5 million of equity in 15 years is now a 1.8% return on equity. So your return went from 10% to 1.8%. And I think that's why it's important to always know your return on equity and know when it's time to either refi some proceeds out to go roll into another opportunity, or exit and do a 1031 exchange into another opportunity. Now, a lot of these buyers are doing 1031 exchanges. Is that right? I'm sorry, the sellers that are selling with you guys?
Majority of them.
Majority of
there's
them.
some individuals that are open to exiting. They don't want to buy another asset. They have had their fair share of scares, and they're just looking to cash out, and they're willing to do owner financing structures, perhaps, or move money into DSTs, or move their money into a tenant in common agreement, or something a little bit more passive. But for the most part, yeah, 1031 exchanges are pretty much the name of the game. We don't see too many people trying to pay Uncle Sam.
Yeah, absolutely.
I wouldn't advise it. But there's extenuating circumstances sometimes that offset the expense. They're okay with it.
Yeah, I think I've done one 1031 exchange in my career, and that was out of a 32-unit building in Indianapolis. And we had I had two other partners on that deal. We set up a tenants in common because typically when you do a 1031 exchange, it's an all or nothing thing. And so typically all the partners need to do it. However, if you set up what's called a tick, you can individually 1031 into the up leg. And so that's what we set up. That's the only one I've done. But I think there's other opportunities for people that if they sell and then if they buy another asset in the same calendar year, they're going to get more depreciation that could offset the potential gains. But I think for the buyers or the sellers that you're working with, I think it makes most sense for a lot of these people just do a full 1031 exchange as a good way to defer. So you'll typically identify the up leg, get the up leg under contract, and then you go to list the other property. How does that work?
Can happen. Sometimes it's putting the cart before the horse, expecting to be able to find an upleg before you sell your property. Because whenever you're finding a deal, sometimes something that the perfect upleg may be on the market, and you're competing with other individuals that maybe are a little bit.
You're not gonna be awarded the deal.
You can't be
Yeah.
awarded the deal if you're not prepared. If you don't have your property at least on the market or under contract, like it's very difficult, especially if you're trying to get a deal. It's putting the cart before the horse, but sometimes it works out. It happens.
Yeah.
I can't say never. It's what we're doing right now. It's what we found. We found a 5-unit off market. Our client with the 4-unit was like, this is exactly the price range. This is exactly what I'm looking for. We found it, and it just happened to work that way. And because we have a relationship with the seller, and because we know exactly what the buyer has, we're like, hey, this is what they have. This is what we're listing at. We can create a thesis basically behind why this is going to work out and make the seller comfortable with the idea of accepting this offer, despite the fact that their property's not on the market yet.
Okay. And in this example, is the upleg, was that a listed deal, or this is an off market opportunity?
Oh, off market
from your network?
Yeah.
Yeah. Very cool.
It was somebody that we knew that was stabilizing assets. They were building ADUs, and they had something coming up down the pipeline. And we remembered like a couple months back having a conversation. And after we defined what this guy wanted to buy, we reached back out to a few guys where they were like, hey, we're working on ADU developments. Here's a couple that we have. And we circled up with them, looked through the notes, and found them. And we're like, hey, listen, I know that you had something coming up here pretty shortly. It's like, oh, actually, we're right in the position that we're considering either 1, selling it, taking to market, or 2, refinancing this into some, out of the construction loan that we have into some solid debt. I said, okay, well, that's interesting. Well, would you be open to selling? He was like, yeah, I sell at a 5 cap. And I was like, all right, sick. What's a 5 cap for you on this property based on the income? And he's like, it's I think it was like 2.45. And we're like, okay, so but you agree that properties in this market, stabilized assets, new builds like this, 5 cap is what you would consider selling it at. Helped him define or agree to that, tied him down to that. What he overlooked was that the tax basis for the buyer in the scenario was going to have an increase in tax basis. They're going to pay a higher tax rate. And he was accounting for that in his calculation for the 2.45. And we ended up kind of like explaining to him like, hey, listen, this is the income. Here's all the expenses that you shared with us. With these numbers, we're doing all the due diligence up front. Like, we're going to shoot it straight. Like, you said you'd sell at a 5 cap. We agreed that a 5 cap, 5.1, 5.2 maybe in this market is what this could sell for. You were in agreement with that. Yes. Well, at this price point, that doesn't make sense. That's less than a 5 cap.
Yeah.
5 cap is at this price point. We secured it for him. Bridge the gap.
Look at that. Saving your buyer money, man. Making deals happen.
Well, just shooting it straight with people. Like, this is what the market trades at. You either trade it at what the market would trade at, or we can't put the deal together. That's fine too. Refinance it. At the end of the day, we don't get involved in transactions that we don't believe in. It doesn't make sense for both parties, especially whenever you're dual representing like this. You're exposed. If it doesn't make sense for both parties, I'm not going to put the deal together. It's not how we do business.
Sure. So with this upleg with the ADU development, had he already leased up all the ADUs?
Yeah, they were all leased up.
Got it. So the thing was already stabilized.
There was 1 unit that's not. And we're actually in the middle of negotiations because this 1 unit we had
struggling
context that there was some renovations, is not stabilized. It needs work, but it is. He went from 4 units that need work to only 1 unit that needs work and 5 units total. So it's not an ADU. This one is an existing duplex that was there. They converted the garage in the middle, and they did a ground up 2-story ADU construction in the front. Anyways, one of the units of the existing duplex, had tenants that stayed there and they never kicked out. They were like, listen, we're not going to kick them out, just going to leave them there, but increase their rents, and eventually they'll move out. Whenever they do, we'll renovate it. There's a little bit more work there than we originally thought, and extended. So right now we're in negotiations. Our buyers right now is like, we can find a middle ground, because what's cool about what we're doing here is buyers and sellers we're actually in communication with, pretty openly. And we've realized that the sellers and the buyers are both really reasonable people. We're actually sitting around like coffee tables, like talking this deal through. Like, here's these concerns.
The buyer and the seller.
Buyer and sellers. Yeah. I'm like, here's where these clients are. This is where you guys are at. I'm trying to help you bridge this gap here. I didn't think I can communicate these concerns as clearly as they could possibly do so. And that's why we're sitting at this table together. Let's figure this out together. Like, your end goal is to sell this property, move your money into this other opportunity. I want to help you do that. Their end goal is to sell their other property, move it into this opportunity. But there's misalignments. There was miscommunication. There was a gap in expectations versus reality. Now let's figure this out together. There's got to be a path forward here. And I think we've come to an agreement. So we're moving that one forward. But that's what's cool about doing things off market and representing both sides. And again, I'm in the business of building relationships. And whenever people understand that I'm working with individuals that are also interested in that, it's not just about transactions, it's not about all the money, it's more than that. You can make pretty cool things happen.
And that's why I love the commercial real estate space, is because in residential, it would be very rare for an agent, especially a listing agent, to bring buyer and seller together and have a conversation. But
And I
in
don't
commercial,
normally wouldn't. Not even on
most would
commercial.
not. And I've asked, I'll ask all the time, whenever I'm in a transaction as a buyer or a seller, I've done this as a seller too, and we reach like a road bump where we're like, hey, there's a little bit of disconnect. I'm like, can we just get on a call? Like, let's just get on a call, or let's meet. Like, it's just you're going direct to the source, and I'm confident in my ability to smooth things over. And I'm always like, everyone should come out of these conversations feeling good about the transaction.
Absolutely.
That's how you create a good transaction. And so let's come up with something that's a win-win. Let's put it together. And the best way to do that is just get on a call or meet in person. A lot of agents are not down to do that, but I have worked with some agents that even offer it. Like when we bought this last hotel in San Clemente, the agent offered it. It was not needed, but he was offered it in the entire transaction. And I love that. It's just
transparency goes a long
way.
ways, man. It makes it
Yeah.
whenever people feel comfortable. Again, we're in the business of building relationships, and I don't feel like there's any other way to build a relationship than to be fully transparent the entire time and show people that you care and actually be there. And like, a part of what we do isn't a large part of what we do and how we differentiate ourselves from a typical agent out there, because that's really where we get paid, is on the buy and sell side of transactions transparently. So unless you want to buy or sell, like, we're not making money. And with that being said, I don't want anyone to buy or sell if it doesn't make sense for them. So I'm going to tell them honestly, like, more often than not, we're talking with people that are like, actually doesn't make sense for you to sell. We'll shoot it straight with them. And that alone builds enough rapport with them that they reach back out to us in the future. And they're like, hey, listen, you shot it straight with me before. I'm going to shoot it straight with you now. I'm actually thinking of selling for these reasons. Can you help us out? We're in the long-term game. But anyways, what I was trying to say is transparency and knowing that we're not just here to put a deal together to make a buck, but we're actually here to make people's lives better, goes a lot further than anything else that we could do.
Yeah. And you playing the long game and building this advisory and this network of like buyers and sellers and trying to like, solve problems for them. I think in, 3 years time, 5 years time, 10 years time, it's going to really compound quickly. But I've always thought, for me, man, personally, and I wanted to get in commercial real estate when I was out of college in 2008. I interviewed with CB Richard Ellis, Grubb and Ellis, at the time. And this is 2008 when the economy was kind of coming down, and they were both like, hey, dude, like, this is not the right time to get in the industry. They pulled those positions. And I was slanging cars in a car lot, and that was kind of my introduction to air traffic control. But I always thought, even today, if I was not doing what I was doing right now, I would love to do what you're doing. I think that's like, I don't know. I just love the art of like commercial real estate, putting deals together, creating win-win scenarios for a couple groups to come together. And I also love commercial real estate, man. It's a beautiful thing.
You can create real impact, man. I've seen real estate. I mean, my father is in real estate my entire life. My grandfather was a developer in the Central Coast up in Shell Beach. And I've seen how real estate can create generational change, generational wealth. And being a part of helping individuals like change like their family trees, like create generational wealth, that kind of being able to create impact in their decision making and helping them, that's what it's about, man. And that's why I enjoy working with investors. Like, I could easily make a couple bucks on the side, like helping individuals. Like, I'll do it for friends, right?
Sure.
Go buy a single family home, be in the resi space. But to me, what I want to help individuals do is really just build generational wealth. And I feel like there's no better way for me to, like, that's where my skill set is. And my skill sets, I'm still pretty young, man.
How old are you?
I'm only getting better. I'm 29.
29, man.
Yeah.
You're just getting warmed up.
Just getting warmed up.
Yeah.
But the more conversations I have with investors in the area, the more I learn about what opportunities are out there, like the ADU space, multifamily development. I'm learning about a lot of these things right now. The more knowledge I can acquire, the more skills I can acquire, the bigger the gap I can bridge for the individual, like, that's here, that wants to be here. The bigger the bridge I can get, bigger gap I can bridge for these individuals. And the more value, the bigger the gap, the more value I can bring, the more I can do for everyone on my team.
I love that, man.
So it's it's a great opportunity to get into real estate. But I feel like it comes down to where your heart's at, where you want to create impact. I think a lot of guys in real estate just do it for the paycheck. And yeah, you can help somebody buy their first home, and that's great. But if it's not about that, it's about the money, then what are you doing? Like, you can get lost.
No, agreed.
Hey guys, real quick, I just wanted to personally thank you for listening to this podcast. It means the world to me. The only way this show grows is by word of mouth. If there's anyone in your circle that could benefit from this podcast, it would mean the world to me if you could share it with them via text or maybe on your Instagram story. And I'll be sure to keep an eye out on my Instagram for shares so I can reshare you on my Instagram story. Again, thank you so much for listening, and it means the world to me. Now back to the show.
And I think a lot of people, maybe listen to this, they think commercial real estate, they don't realize, especially when you're going into a new market, you don't know anyone, you're building your network. It's a lot of phone calls, it's a lot of dialing, it's a lot of hours of work. Maybe speak a little light on how many phone calls you're making, how many hours that you're putting in trying to build out this list.
I'll take it back. So whenever I first got into real estate, I pretty much, like yourself, you cashed out your 401k and went all in on what you were doing.
Sure.
Right?
Yeah, 100%.
I did the same thing. I was working at a bank, cashed out everything. I was like, listen, I'm done working
401k?
401k
Really?
and all.
What
Yeah,
bank were you working at?
I was working at US Bank.
Okay.
And it was great. But
I didn't know you did that. What were you doing there?
just banking, man. I got a little bit into business banking, and I was just like, why am I here? And the corporate ladder wasn't for me.
Yeah. So you're like setting up business bank checking accounts and all that sort
Yeah,
of stuff.
selling loans,
Business
selling
credit
debt.
cards.
It's
Saw
cool. Getting to know a lot of people, but I quickly realized like that my favorite clients were the individuals that are in real estate. And I was like, okay, I want to figure out how to get into this. Let's figure this out. So I walked away from what I was doing in banking, cashed out everything, and I had just enough to get like 3-4 months worth of get by on 3 to 4 months. Like I had that tight of a time frame to make some money, and nobody makes money in 4 months in real estate. Nobody. So I went out there and I interviewed everybody in San Luis Obispo. I moved from Camarillo, that's where I was at the time, up to San Luis Obispo, and that's kind of like where my that's partly home. Spent a lot of time there, went to college there. Anyways, I interviewed basically every broker out there. I was like looking for an individual that inspired me, looking for somebody that was out there trying to do things a little bit differently, that was making a name for themselves and hustling. Not the individual that was waiting for the referral business, and they've been doing this for 30, 40, 50 years, and all they have is people calling them. Like, I'm not that guy. I don't have those kind of connections. I need to figure out how to make money, and have control over it. And I found a guy, and he was like, yo, I'm not, bringing anyone in on my team. Sorry. It's like, oh, that's cool. No worries. I see you're making big moves. You're closing a ton of deals. You have a huge amount of volume. You're my age. Would like to get to know what you're doing, how you're doing it. He's like, sure, show up to my office. I got time for a 15-minute phone call. Showed up to his office, and we're talking for a little bit and getting to know who he was and what he did, where he's from, kind of same hometown, upbringing, roots, everything. It's just aligned. And this guy was like, yeah, it's, great meeting you. I wish you the best of luck. And I was like, you know what? What would it take for me to be on your team? It's like, I got no room on my team. I'm not for anyone else on my team. I'm like, what would it look like though? He's like, you'd be calling 8 hours a day. You'd be doing 3, open houses a week. You'd be working 6 hours, and I'm not going to pay you. I wouldn't pay you. I said, that's fine. Anything else? He just sat there and was laughed at me. He was like, are you serious? You're down to do that? I said, absolutely. I was to the point at which whenever I jumped into real estate, I knew for a fact that
there was going to be a period where
I had to do, I would not let myself fail.
Yeah.
And I saw that he had a way of doing business that would ensure that I wouldn't fail. And I wanted to figure out what it was.
And what was it?
Dial 8 hours a day. Dial out 8 hours a day. Learn how to talk to people.
Yeah.
Figure out who has money, where the money is. Piece some deals together. It was a residential at first. And I did that for a year, and I closed, 3 transactions in the first 3 months of being in real estate, which was a great little start.
Damn, that is a big start.
That team ended up dissolving relatively quickly.
Why?
Conflict within politics, you can say, within the company. But ended up having to do my own thing with a couple other buddies that were on the team as well. And
that was Armand?
That was Armand, another buddy from San Luis Obispo as
well.
Got it.
And what year was this when you and Armand were like, hey, let's just start our own thing?
I was 22. We just started
7 years ago? Or 2022?
2022.
Got it. So 3 years ago.
Yeah. Was that? Yeah. Wow, time flies, man. That's 22. And then we decided to bring the business down here.
Yeah, what was that? So you guys were up north. and you already had your client base up there, and you still have those clients up there, right?
Yeah.
But now you're starting fresh down here in addition.
Had to start fresh last year.
Yeah.
Still had the clients up there. So 75% of our business was up there last year, but I would say 85% of our business is now down here.
And dude, I first met you on a yacht meetup last year. Armand was there, and I want to say it was like almost a year ago. But you guys came out on the yacht meetup, and I remember asking you guys what you did, and I first heard the business model. I remember we were like cruising right below the U.S. Midway, the aircraft carrier, and you were explaining the business model, and I thought it was very unique and cool. But anyways, that was right when you guys brought it down here, right? So you guys are going to events. You guys are trying to like network and meet other real estate investors, meet people in the space, right?
Absolutely.
Yeah.
And now we have, 1,000 investors that we've communicated with over the last year. We have info, emails we communicate with. We're seeing newsletters too. We're circling up with, staying in touch, figuring out where they are, what they're looking at, how they want to move their assets or portfolios, this year, what's changing, how's life, and we're just putting deals together. Large part down here now. Still doing other stuff like in the Bay Area as well as the Central Coast, a little bit in OC. So CCG stands for Coastal California Group. So key coastal California markets is what we're focused on.
My favorite markets.
It's where we're all
high
at.
growth, barrier to entry, low supply, not a big risk of new development. And I think if you look at the history of real estate in America, California coastal is like organic appreciation just happens like clockwork. Every 12 to 15 years, everything's doubling.
Can't mess up if you're buying in the right areas.
Yeah, no, you can't. And they're not building more beachfront real estate. So I love it. But yeah, I mean, back to the downline, man, I think regardless of business, regardless of what you do for a profession, I mean, it all comes down to just the reps and the at bats and just talking to people.
And then eventually stack the skill set, like I said, that you're able to make less phone calls. You understand, like at first, you got to make a lot of phone calls. You have to talk to a lot of people. You got to get involved in a couple transactions, even if they're ugly. You got to stumble a little bit. You got to fall on your face. But after you stack the skill set and the knowledge, the competence to be able to communicate with people and actually add value, then the opportunities come to you.
Yeah.
Especially if you're servicing people from with the right heart, truly seeking to better their lives and go above and beyond. Show them that you care, and then they'll bring business to you in the future.
What does Armand do, and what's your kind of role in the company? Do you guys complement each other, or you guys do a little bit of the same thing?
So he's got a background in financial services. So he's helping people invest their money. He was working for a company, Fisher Investments. And then he started, he worked for Marcus and Millichap for a little bit. And then he got with this group that basically had a fund, and they were acquiring assets in the large part of the Sun Belt states. So he was in he got to see what institutional advisory looked like for the institutional real estate investors. He got to see the insights on that. And that is kind of how we got to where we are today, where we're trying to bring that kind of level of advisory that mom and pop investors don't get to see today. They don't have that type of service. Nobody's doing that for anybody that owns less than 25 assets or even up to 50 assets. You can own 50 assets and never work with an advisor that actually wants to hold your hand and help you out, show you what options you have, evaluate your portfolio.
Mm-hmm. Yeah. I mean, a lot of people have financial advisors, and they'll manage and advise on their, stocks and their, paper assets, but not a lot of people, have people that advise them on the real estate play, people that actually understand the real estate. Most financial advisors probably don't even own real estate. I always think that the financial advisor thing is ironic because you're going to a financial advisor to advise you on investments. But how do most financial advisors get paid? Most of them are employees. They're not getting paid through their investments, but they're advising people on their investments. And so it never really made sense to me, right? So I love what you guys are doing. You guys are advising clients on the real estate investments and that sort of thing. And it's what you guys live, breathe, and you guys are, helping people genuinely, and creating win-win scenarios for everyone involved. So I love it. And also commercial real estate's evergreen. It's going to be around forever.
Yeah. It's not going anywhere.
Yeah. So what's the biggest challenge that you guys kind of foresee? What's the biggest risk to this model, and what's maybe the bottleneck for you guys to kind of grow this thing? I'm curious.
Bringing in the right people to the team.
Mm.
Right now we're of the opinion of quality over quantity for the team itself. We hired 4 people last year, had to fire those same 4 people. We have a core 4, my business partner, Armand and I, and then 2 other guys that we're training to do what we're doing. They're our acquisition team pretty much. They're acquiring the new clients. They're helping our clients that we have acquire the next properties. They're cold calling. They're learning. They're young. They're straight out of college. Their hearts are right. Finding people with the right values that want to service other people to the level that we expect them to service other people. Scaling the team, which is going to take some time. As far as the clients, man, the clients are coming. Like I have no fear of like us. I think at some point maybe we're gonna have too much work to deal with, and we'll have to cap out like how many clients we're working with at a time until we scale the team up to a level which allows us to expand our clientele, active clients. Other than that, man, yeah, just growing the team, the core team.
Yeah. Yeah. I mean, I think good people is like the number one thing. It is like the most important thing. And I think it's a big lever and a huge ROI having, talented people, team members that are actually A players moving the needle. And it's something that I've kind of learned as I progressed. I think early on when I first started hiring people, I would hire people I knew, people in my circle, and I didn't really know at the time what good talent looked like. I didn't. And then, I accidentally kind of stumbled across good talent. And I'm like, oh shit, that's what good talent looks like. And then it raises the bar for everyone, and then, every year I'm always evaluating and, we'll cut the weakest link and we'll rehire and bring in like an A player. And then it resets the median bar every time I do that. And now the culture is really good. And, it's all A players, and it's the only way I'm going to do it. The only way I'm going to do it.
A players want to be surrounded by other A players.
They do.
They do.
They do.
All it takes is one C player to bring down the bar for everyone else.
Brings down the bar, but you can also lose A players if you bring in a C player and that person's not holding their weight, and then other A players have to go, basically compensate and clean up after their mess. That's a good way to lose them and also loses trust. So the only way I'm going to do it moving forward is only bringing on A players, and if that means paying above market, giving equity, like revenue sharing, like all that sort of stuff, like easy decision. The alignment of interest is huge, I think.
Yeah. And I think morals, man, bringing in people that care, that see the vision, that want to be a part of the vision and want to push the vision forward, that align. Core values. You have to have pillars in your business that are defined. And as long as they align with those core pillars, then that no matter what, you guys are along, you have the right mindset and the right people are on the team, and maybe there is room for improvement. You could push them, and assuming they want to be a part of it and they want to improve, they're coachable, then yeah, that's what it's about.
Mm-hmm. And a lot of it is like your time, right? And so you got to ask yourself, what's the value of my time? And because you bring someone in that's not an A player, you're going to have to invest a lot more of your time into getting them into where they need to be. And they're going to have a lot more questions. There's going to be a lot more time spent training. But you bring in someone that's got the experience, they get it. It's plug and play.
Plug and play, man.
Yeah.
Yeah, I think at a certain point in business, you start looking at your time differently.
Oh, totally.
We were just talking
Well,
about
there's
that
only so
before we
much
got
of
on the
it.
pod.
There's
right?
only so much of it, yeah.
We were looking at that big ass whiteboard of yours. It's like, how in the world in my head, I was just like, how are you handling all these things? And the large part of it is delegation. You learn how to delegate properly, right? It
Sure.
protects your time. But at a certain point in life, like there's a lot of things that you have to be involved in. And it's like, okay, well, you have to define where your highest return on time is. There's some things you have to let fall off the plate. And you got to figure out who's going to catch that and delegate that. But like the things that require that will give you the highest return on your time is what you should be prioritizing your time on. Everything else will be delegated eventually. Take as much as you can, but double down on what's working, what pays you the most.
Totally. Question for you. So when you have a client you guys get on a call with, and they're like, hey, I'm interested, but like, what are your thoughts on the real estate market? Where do you see interest rates? What are your thoughts on the market? Is this a good time to sell, buy? How are you advising those clients? And I guess I'm more curious, and personally, like, what are your thoughts on the real estate market today?
Well, the market is no longer going up. I think that's safe to say. Whether it's going sideways or down is, I think, depending on where we're talking. But there's a lot of positive sentiment and then there's a lot of negative sentiment out there. It's hard to tell. Nobody's got the crystal ball. At the end of the day, it depends on the clients, what they have, how they're doing, how much equity they have, how long they've owned the asset. I think there's always room, even in a market that's going downhill, to make more money, to do better, to improve your position. Even in the market that you're going down, I mean, if you're selling an asset, today is going to be the day that it's worth more than it will be tomorrow. Yeah, I really don't. Nobody's got the crystal ball. All we know about is what we got today. Interest rates at, 6.5 to 7.5%, depending on what we're lending on, how much what the LTV is on the property that you're trying to acquire. And as long as you can make the numbers number, then, I mean, it's just numbers. That's all it comes down to. If the maths, and be as it may.
Totally. I personally feel like because we've been in a high rate environment for 36 months now, almost exactly 36 months. I want to say it was February of 2022 when the Fed first announced their first rate hike. And those 3 years went by quick. But what I do know is liquidity for Americans are at an all-time low, regardless of what individuals are making out there in the marketplace. People have bills, they have mortgages, they have car payments. Even if someone's making $400K, $500K a year, their kids are probably in private school. And how do people re-up on liquidity? It's by refinancing their primary home that they live in. That's how 99% of Americans re-up on liquidity. And no one's been able to refinance in 36 months. And so I think liquidity is an all-time low. I think credit card debt is at an all-time high. And so I think this has been like the most low-key, under the table, quote unquote recession that has ever existed. It's not really marketed on the news. And I think a lot of that is because the stock market over the last 3 years has done relatively good, with maybe the exception of the last, month or so where it's down. But other than that, the stock market's done great. Real estate prices have held strong regardless of the rate environment. And so I think because of that, people are like, oh, we're not in a recession. Now, unemployment's starting to tick up and we're starting to see some people get squeezed, and we're starting to see some deals shake loose. I think a lot of the sellers in the marketplace that maybe 2 years ago, 3 years ago, when the rate environment started going up, were like, hey, I'm going to hold off. I don't need to sell right now. I think some of those individuals, they're like, okay, they're realizing, the rates aren't going to go down anytime soon. And so maybe some of those individuals are finally ready to sell. But I believe, and I'm speculating, I'm always willing to be wrong, I believe 2026 will be a recovery year. I think we'll continue to see some rate cuts next year, and into 27. I think 27 will be another recovery year. And I believe 2028, we will look back as real estate investors at 2025 and be like, man, I should have bought more assets then when I had the opportunity to, assuming a couple of things. And this is something that I've kind of held true to over the last 3 years, is like, I knew the market softening over the last 3 years, high rate environment, it's got to soften. And so for me, the only way we do a deal is one of two things. One, buy below market. Two, we got to add tremendous value. And three, it's got to be in a great location. And I know as long as I'm acquiring these assets and I have a 10-year time horizon, there's going to be an opportune time in that 10-year window to have an opportune exit. And so, for me, that's kind of what I've always lived by. Every deal I bought, I've been able to add a lot of value. I've been able to buy in good locations. And, knock on wood, the Cincinnati deal I'm selling right now, that's a whatever location. Cincinnati's cool market. Like, yeah, it's great.
It served its purpose for you. Got you started.
It served its purpose for when I got started. Exactly. I bought it for $30,000 a unit. You know what I mean? So it was like 11 units for $350,000. It was my first real estate deal. But that deal is never going to be worth $5 million. And so I'm like, you know what? It served its purpose. It gave me some experience. And I'm under contract right now with a buyer. And I'll sell it for more than double what I paid for it 6 years ago. But it's time to move that into bigger and better things. And so I think the takeaway for, at least for, anyone listening to this that's like wondering what's going on with the market, I think right now there's not a ton of buyer competition. I think that rates are still high. There's still bad news in the marketplace. I think the market will continue to soften before it improves. But I believe that sometime in 26 and definitely by 27, things are going to heat up and the news is going to turn around. The rate environment will be lower, and I think there's going to be a lot of buyers that are on the sidelines now that enter the marketplace. I also think that the Federal Reserve has printed 80% of the money supply since 2020, and although a lot of those chips are off the table because of the high rate environment, I mean, you can get 4%, 4.5% risk-free in a CD. So a lot of that money is parked right now. But I think as the rate environment comes down over the next couple of years, I think a lot of those chips will re-enter the playing field. And I believe, like you said, the way to build long-term wealth in real estate investing, I truly believe, is to hold these assets long-term. Let time do its thing. Let inflation do its thing. And I want to be a net buyer long-term, not a net seller. I want to build $1 billion real estate portfolio with Summers Capital and with everything that we're doing. And I know that you don't do that by selling a lot of these assets. You do that by buying more and more assets and buying good assets to where you can add a lot of value and refinance your money out and continue to roll them into more assets. So we'll see. But I think, as long as you're playing a long-term game and, you're buying assets in good locations, you're buying them below market value, you're not overpaying, I think you're going to do relatively well, even if you buy it this year.
It's not about timing the market, although there's a lot of money to be made whenever you time the market perfectly, but it's more so time in the market. Pull the trigger,
Time in the
take
market.
the risk, do it.
Always.
You'll never look
Calculate a
back.
risk. Calculate a risk.
Yeah, they of course. Make sure you're buying in the right area as well. It's everyone says, yeah, the best time to buy was in 2021 and 2020, 2021. And yeah, but the second best time to buy is today. Pull the trigger.
That's
Make
so
it happen.
good.
If it makes sense. If the maths.
Yes.
Let's go.
If the math, let's go. I love that. I said at the top of the show, we would circle back.
Oh,
What
my
happened?
gosh.
What happened at the San Diego monument over there at Point Loma? You had federal guards coming in.
Let's
you
just
got
keep
locked
that
in.
real short and
Yeah.
sweet.
And
The
who was
place
the lucky
closes at
female?
5.
Who was the
It-
lucky female? That's what I want to know.
Listen. If the place closes at 5, you should probably be out of there by 5. They don't always tell you it closes at 5.
That's early
And,
with the time change. I'm like, dude, 5
The
o'clock.
sunset was at 7. I was like, I'm
I'm
gonna hang out here.
I'm
and
just
watch
getting warmed up
sunset.
at 5 o'clock.
Yeah, it's like we got there at 4, and they're like, things close at 4. Or like the trails close at 4, and I was like, well, can't close the trail if I'm on the trail. So we got on the trail before 4, but didn't come back the trail to my car until about 5:30. Park was closed. People were gone. Nobody. Ghost town. Went from like Disneyland to ghost town in like a quick 30 minutes. And my car was the only car in the parking lot.
Damn.
The federal citation.
But at least you had some good company.
Yeah, well, yeah, a great time. But at the end of the day, I mean, you should probably not put yourself in the position to have to call the Navy police to come
Damn.
get you out of the
Come and
park.
escorted out by Navy police.
Yeah,
Big
yeah.
Joe.
Let's not do that. Just
Yeah.
don't do that. Get out of there before 5. I don't
Yeah.
know what it costs yet. I'll let you guys know here pretty
Yeah,
soon.
let me know what that costs.
I'll
I'm
have to
curious.
circle up. It's probably not going to be pretty.
No, that's crazy. Okay, well, that's a good takeaway. If you guys go to a national, is that considered a national park?
I don't know what it is. I
Yeah.
just kind of stumbled across it, to be honest. Never been to it.
It's an interesting location because if any of you guys visit San Diego, check it out. It's great views there, but you basically take Point Loma out past Sunset Cliffs all the way down to the tip, and at the tip, it's called the Cabrillo Monumental Park. I don't know who
Yeah.
owns it.
I don't know if it's a national
it-
park.
it-
It's federal
I think
land.
that land is Navy, but you pass a bunch of like graveyards.
Yeah.
Is it called? Those called monuments or graveyards?
Graveyards, yeah.
Graveyards.
It's a grave
you pass,
site.
you
Yeah,
pass a
and
bunch of graveyards.
I think it's for the military.
But anyways, you get out there, you pay like a little parking fee or whatever to use the park. They got good hiking, and it's like you literally see the Pacific Ocean on one side. You see the downtown San Diego Bay on the other side with like the downtown skyline. Very, very beautiful, very
Nobody
gorgeous.
knows it's there.
No, nobody knows it's
I
there.
live on Catalina in Point Loma. I see the bay. I have the bay side. I was there 7 months. I had no idea it was there.
Yeah, just don't bring a female and disappear for hours because you might get escorted out by a federal police. So
Yes. Get out of there before 5.
Joe, I appreciate you coming on, man. I'm a big fan of everything you're doing. How can the folks get in touch with you? And especially, how can the folks get in touch with you if they want to learn more about using your potential services?
So I don't really have a social media presence yet. I got an Instagram. I got a website.
Let's build this baby up, man.
I know. That's why we're talking, brother.
Let's make this kitty
So
purr.
on Instagram, it's ccg.rea. You can find us. We have a couple stuff on there. Not much, though. Our Instagram is pretty quiet. It's going to change here pretty soon.
Life
With a
of
little help
Silva?
of you.
At Life of Silva?
That's my personal, yeah.
Okay.
Life of
Go
Silva.
shoot
Life,
Big Joe
Life of
a
J
follow.
Silva.
And then lastly, what's the name of your podcast?
Modern Disciples.
Ooh, that's good.
That's going to be more of a personal brand, talking about faith, business, and health, and how the three intertwine, and how faith has driven everything I do.
I love it.
It's what my business is based on.
I love it.
Serving others and helping God's people. So yeah, that's coming up. still early days. Only got one podcast done. I got, I think, 2 more lined up in the next month and a half.
There you go. And you can push this episode out on your feed too. That's another good way to get more episodes in. I do that all the time when I guest on other people's shows. Boom, I'll push it on this feed as well. There you go. Joe, I'm a big fan, dude. Keep doing what you're doing. Keep crushing. He's Joe Silva. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you guys on the next one. Peace.